Atlassian Corporation's cloud business accelerated to 31% growth and margins nearly doubled. Then management guided next year's growth cut in half. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Atlassian Corporation gets graded and traded. So on the headline, revenue came in about 6.26% ahead of estimates and grew 28% year over year to $1.77 billion. Cloud revenue was the star. It actually accelerated to 31% growth at this scale, which is the kind of number that turns heads. And on EPS, they beat by about 47%. That's a huge beat driven by real operating leverage. Non-GAAP operating margin expanded from 24% a year ago all the way up to 36% this quarter. So on the beat itself, this earns a B. A 6% revenue beat paired with a 47% EPS beat is a strong print. The EPS number is genuinely impressive, but revenue came in solid rather than spectacular, which keeps this out of A territory. And on consistency, this earns an A. Atlassian has a very reliable track record of beating on both lines, and this print keeps that streak fully intact. Let's talk about the positives from the report. The single biggest one is cloud revenue accelerating to 31% year-over-year growth at $1.21 billion. At this scale, growth is supposed to slow, and it did the opposite. That's the number that validates the whole enterprise AI story. The backlog tells the same story, remaining performance obligations, or RPO. Basically, contracted revenue not yet recognized, surged 44% year over year to $4.82 billion. That's growing way faster than revenue, which means enterprises are signing bigger, longer deals. On profitability, the operating margin story is genuinely impressive. Non-GAAP operating margin jumped from 24% a year ago to 36% this quarter. That's not incremental improvement, that's a step change. Cash generation backs it all up. Q4 free cash flow was $475 million at a 27% margin. The cash engine is now funding the AI investment cycle instead of being consumed by it. And the one I'm paying the most attention to. The CEO and co-founder announced a $250 million plan to buy his own stock in the open market. That's a real insider vote of confidence at these levels. So on profitability, this earns an A. Non-GAAP margin expanding 12 percentage points year over year, GAAP flipping positive to 12%, and free cash flow at a 27% margin. That's about as clean a profitability picture as you get. Now, let's talk about the negatives from the report. And the biggest one is right in the guidance. Full year fiscal 2027 revenue is guided to about 13% growth. They just delivered 26%. That's roughly cutting the growth rate in half in a single guide. Margins on the forward year step down too. Non-GAAP operating margin is guided to about 25% for fiscal 2027 versus the 30% they just delivered. So margin compression on the forward year despite all the AI talk. The near-term print is where it gets uncomfortable. Q1 revenue is guided to $1.7 billion at the midpoint, which is actually a sequential decline from the $1.77 billion they just posted in Q4. The next print is not going to look like this print. Data center revenue is guided to shrink about 17% for the full year. That migration headwind is accelerating, and cloud growth has to more than absorb it, which is a lot of pressure on one segment. And even though Q4 GAAP margin flipped positive, the full year still came in with a $54 million GAAP net loss. The business still leans heavily on stock-based comp adjustments to hit the headline non-GAAP numbers. So on guidance, this lands at a D+. Management gave a full guide. This isn't a visibility issue. but they cut expected growth roughly in half and stepped margins down at the same time. Even if the deceleration is partly the data center roll-off, that's a materially weaker forward setup than what just got reported. And on red flags, I'm at a C+. The business itself is working, but the 17% data center decline, the Q1 sequential slip, and the fact that the full year is still a gap loss are real concerns that keep this from earning a higher mark. Putting it all together, this is a print where the exit quarter and the forward guide are telling two different stories. The exit quarter is genuinely strong, cloud accelerating to 31%, RPO up 44%, and real GAAP profitability for the first time in a while. But the fiscal 2027 guide asks investors to underwrite a deceleration year with revenue growth cut roughly in half and margins stepping down. When you weigh the strong quarter against the weak guide, I'm giving this print a B. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. I'm not chasing this thing into the fiscal 2027 guidance selling. That deceleration story is going to pressure the stock, and jumping in early just means I catch a falling knife. History says it takes 5 to 10 sessions after a print like this for the market to digest the new outlook. That's when I get better strikes and calmer implied volatility for selling puts. The CEO announcing a $250 million 10b5-1 buying plan gives me a real reference point. If the founder is stepping in at these levels, that's where I start thinking downside gets supported. So I'm waiting for the guide selling to finish before I do anything. That fiscal 2027 revenue guidance around 13% is well below the fiscal 2026 pace. That means I'm going wider out of the money on my cash-secured puts than I would have going into this print. The business is fine, but the market is going to reprice this stock toward a mid-teens growth multiple instead of a mid-20s one. I'm setting my strike floor with that repricing baked in. First quarter fiscal 2027 is going to show a sequential revenue decline, and that headline will spook people. So I'm only selling strikes where I'd genuinely be happy taking assignment. For me, that means wider strikes I'd truly own. I'm holding my core position here. Cloud accelerating to 31%, remaining performance obligations up 44%, and fourth quarter GAAP profitability all tell me the long-term story is working. The founder committing $250 million to buying shares is a meaningful insider signal. That's not a token gesture. That's real conviction from the person who knows the business best. That said, if I have an oversized position and the stock rallies post-print, I'd trim into that strength. The fiscal 2027 guidance points to range-bound action for a couple quarters before the AI monetization story can reaccelerate the multiple. So I hold the core and trim any excess. The fiscal 2027 guidance puts a real ceiling on near-term upside for my covered calls. That means aggressively rolling my strikes up isn't warranted right now. I'm letting my existing strikes work. If they're tight and get called away, I'm okay with assignment, rather than chasing rolls into a stock that has a compression story hanging over it. If the stock trades weak on the guidance, I think about closing my calls early. Then I can reload at better strikes once implied volatility resets, since the first quarter sequential decline caps how far this thing can rally short term. So I let them work and accept assignment. My 12 to 24 month leaps thesis is intact and honestly arguably stronger. The teamwork graph moat. 3 Gartner Magic Quadrant Leader designations, and the platform winning in AI all support the multi-year story. The MCP server crossed 1 million monthly active users, and Ken Exner, joining as Chief Product Officer, adds real firepower to the AI platform build-out. Those are the things I care about on a multi-year horizon. I'm holding my leaps through this guide-driven weakness. Fiscal 2027 is a transition year, not a broken thesis, and I'm waiting to roll up until cloud growth guidance stabilizes above the 25% zone. So I hold through and don't roll up yet. The release validates my fundamental thesis. Cloud accelerating, remaining performance obligations up 44%, GAAP profitability, and the founder buying $250 million worth of stock all tell me this is a validate and average down setup, not a cut losses setup. I'm adding in pieces on guide-driven weakness rather than dumping all my capital in at once. This gives me room to keep buying if the stock keeps drifting lower through the transition year. The CEO's 10b5-1 announcement is my conviction anchor here. If the founder is willing to commit $250 million at these levels, then adding in size on further weakness is defensible for me. So I average down in pieces, not all at once. Bottom line, this print earns a B from me. The business itself is clearly working, but the guide-driven deceleration is going to create real near-term price pressure. And the founder's $250 million buying plan is telling you where he thinks the downside gets supported. Thanks for watching, and I'll see you on the next one.